on the line and just quickly, introduce yourself. What's your platform, and how many of MaC's funds have you been invested in?
Yeah, happy to start. Mitchell Kirkstra, been with the State of Michigan for about 5 years. It's a $125 billion pension plan. We've been with MaC now for 3 funds. It's been excellent, great relationship, always great, great to spend time with you all. So happy to be here, happy to talk a little bit more about the relationship, what we're seeing in the market.
Thank you. And the check is in the mail.
Hi, Jasmine Richards. I'm at Cambridge Associates. So we're a $600 billion asset manager. We work with clients ranging from individuals on up to corporate and public pensions, but I think our legacy is in the endowment and foundation space. And we actually have been working together since 2019 in Fund 1. And Charles, we were talking about the new office. I think I got to go and see an update. Last time I saw was the old one. So nice to be here today.
And I'm Akar Vashani, managing partner at Fairview Capital. Fairview is a fund-of-funds platform focused on emerging managers and venture capital. We have been investors with MaC since Fund 2 and 3, but we've known Marlon for much longer than that.
Yeah. Thank you all for your continued support. Let's jump in. We'll start with kind of a open market question, right? So, venture reputationally has taken a little bit of a hit over the last few years, right? Limited DPI, no returns, just a stagnant market. What do you say to that, right? Is venture done? Are you still excited about it? Like, what's your perspective?
I mean, I'd say personally, I'm still pretty excited about it, considering it's where I spend most of my time here. So, no, I think that it'd be short-sighted to say that it's dead or that it doesn't continue to have legs to run in the future. Ultimately, I think this comes in cycles, and we've seen it before. And for us personally, I think we're really long duration kind of investors where we're not as worried about the short term. We're worried about the long term.
I don't think venture is dead. I think what people have been grappling with is the dispersion, right? I think you did an excellent job, right, like presenting the facts in the beginning, right? Like, and all of that is true. Yeah, great. And so I think for those reasons, I don't think venture is dead. I think what the LPs have been struggling with is the dispersion and therefore their ability to select, right? So if we look at venture, you have, with the latest charts that we've updated, right, like a 31% spread between the median to that top 5%. And so the question is, do you think you're going to, sort of be in that upper side of that spread? And I think where you've heard a lot of the issues is from everyone that's on the bottom. I would never discount, I think particularly here in the US, right, like everyone's ability to have arrogance and confidence in themselves. And so I don't think venture is going to be dead. But I do think that LPs are more sober about making that selection, right? Like, and I think for new allocations, what you have to compete against not only is why something's a good idea, but why it's better than what I'm already investing in, especially if I'm paring back that portfolio.
Yeah, I mean, totally agree. I think, what underpins venture, it's innovation. Innovation has been persistent. It's accelerating. I think it's obvious to anybody that's paying attention to what's happening in AI. It also happens independent of economic cycles, typically. So as long as we believe in innovation, we believe that, there's going to be value creation that happens in venture. I agree to Jasmine's point that it's been very obvious that the dispersion of returns for a while have been trending upward. I think that will continue. AI has magnified the winners. It's going to create a bunch of losers as well. But there will be a lot of value creation. The challenges that LPs have had, I think, is not only manager selection, which has been made harder due to the increased dispersion, but also inconsistent deployment, right? I mean, you had people that were not thinking about venture long term, kind of got caught up in the hype that happened in 2020, 21, then pulled back. Like, that's just not how you can invest in venture. The question is not, should you invest in venture today? It's like, the answer is yes, but you should have also been doing it yesterday, and you should also do it tomorrow, and be consistent and have discipline as you do it. But if you do those things, we certainly believe that there's a ton of value creation to happen here.
Very encouraging. Mitch, I'm going to go to you. You answer to the Michigan taxpayers, right? Essentially, and pensioners, right? How do you validate the fact that you're investing in an asset class where you may not see liquidity for 10, 12, 15 years?
Yeah, I mean, for us, I think it's relatively easy to justify from the perspective of, when you think about portfolio construction at a broader level on a $125 billion pension plan, venture program right now is sitting right around $5 billion. And so $5 billion is a lot of dollars in a grand scheme of a portfolio, but when you think about it from the perspective of the broader pension, it gives us an opportunity to drive outsized value and get access to, potential great direct co-investments and things of that nature that can ultimately really, move the needle in a bigger way. And so, again, to the point that I made previously about, duration and how we're long-term investors and we're not necessarily scared of the, the 10, 12, 15-year kind of holds. We're very, long-term returns driven, and I think that that's where we can ultimately make the, we can make the assumption that the pensioners will be happy that we're taking big swings and hopefully, hitting those home runs from time to time and moving the needle for them.
Awesome. The question for any of you can jump in here, but we've gone from zero interest rates, right, high valuations, to markedly tighter environment, right? How has this macro reset changed the way you guys are underwriting new fund commitments and re-ups?
I mean, I think the change in interest rates changes the level of interest across the rest of your portfolio, right? So part of, I think, the attention that privates and especially venture got was because my fixed income isn't particularly interesting, my public equities isn't particularly interesting, right? And so you can spend more times on looking at ideas in other areas of the portfolios. We just had our, partners meeting recently, and one of the most, well-attended session was, around 130 and 30 extension strategies, right? So, and I don't think anyone was particularly wanted to talk about hedge funds for probably the last 10 years, right? And so I think first, right, there's just more competition for attention, right, of where you're allocating. But I do think that people still get the point that you have to do venture. It's just the bar is going to be way higher. I think also this idea of, just sourcing deals, I think the shift in terms of what you're selecting has really moved to how are you driving value and which game are you playing, right? I think when you mapped out the two types of funds earlier, I think that was a, very true assessment. And so it's, does the manager understand which bucket they're in of those two, and are you building a firm and a fund, right, to address those?
Yeah, I mean, I think the interest rate environment, it certainly impacts how our LPs think about committing to Fairview, but as a fund of funds, once an LP makes that decision, our job is to then just go out and deploy capital over the next 3 to 4 years in a disciplined way. And we're not necessarily thinking about the interest rate environment and how it impacts our investments, right? We've historically always tried to underwrite managers independent of that. We don't want to back people that are relying on cheap capital to succeed. These should be GPs that know how to build and scale and exit companies throughout different market cycles, right? So that's what we're looking for. And again, to our first question, there's gonna be a ton of value creation that's gonna happen, and that's, interest rates will be what they are, but that's going to happen. And so they'll be, regardless of where the interest rates are, beyond that, we think there's tons of potential in venture.
This one's for you, Akar, and Jasmine. I mean, both of your organizations work with endowments, family offices, foundations, et cetera, right? What's their sentiment right now, right? Are they still bullish on venture? Are they generally wanting to sit on the sideline? Do you feel that you're having to convince them that this is still an asset class that they need to deploy to?
I think there's so many syncretic things here. Not every endowment foundation is facing the same issues. They're not in the same positions in terms of cash, how they've invested, all that stuff. So it's hard to paint everybody with a broad stroke. I think, there are folks that are challenged for all sorts of different reasons. Maybe it's constraints on capital, have they deployed? Maybe it's a political environment. I mean, there could be so many factors. But I guess if I take a step back, definitely, like over the last year, I think there's been noticeable increase in interest in venture, and it's been because of all the headlines, right? And you're seeing all the value creation happening. So, yeah, it's hard to say, you know, across all of them. Like,
Anything to add, Jasmine?
Yeah, I think ultimately allocation decisions are going to happen in two pieces, right? So there's the piece where we're going through the portfolio and saying how much are we going to allocate, you know, to privates, how much of that is going to be venture, things like that. But then the individual decisions, right, like are made one at a time. And so I don't think the debate is, should we have venture as part of our portfolio? I think where you're seeing the resistance is when you're evaluating individual ideas, and and that then can, you know, tailspin into, well, we already have this much allocated to venture, right? Like, do we want to, where do we think, you know, that piece of the portfolio actually is valued at, you know, and do we want to make new commitments? And then do we want to make new commitments to this specific idea? So I think that's where you're getting a lot of the resistance. I think specifically for endowments and foundations, you also have to think about some of the, I think, the ecosystem issues that are around those individual institutions, right? So if you're an endowment in a school, right, like in a world where you have less international students, right, like you have, you know, less grants that might be coming in to support your research. I think there are conversations just around what does our budget look like, how much of that is coming from the endowment, right, like, and is that increasing or decreasing, right, like where do we think that's going in the future, which then may dictate what liquidity you want in your overall portfolio, which then may trickle down to, are we making new commitments in venture? I think if you're a foundation, particularly here in the US, you might be concerned about, right, like whatever the mission of that organization is, and be thinking about, is this a time where you want to increase your spend to support those missions, which then may, you know, impact what do you want your liquidity position to look like, and therefore are we doing venture? So I don't know that people have specific concerns around should we be in venture. I think it's all this other stuff.
It's helpful. I guess for all of you, and I admit you haven't spoken in a while, so we'll start with you. You know, we talked about kind of the bifurcation of the venture business, right? The mega funds versus the sub $400 million, I'd say more disciplined funds. How do you view the two from a portfolio construction standpoint, right? Like, do you need both? Do you only need one? Are there benefits and drawbacks to each?
Yeah, no, I mean, we certainly have both, and I think that we, you know, have a pretty strong opinion that both of them make sense in a well-diversified venture portfolio. Ultimately, you know, when you start to get into mega fund side of things, you know, the question then becomes, you know, how do you balance multiple mega funds within a portfolio, right? Because a lot of times there's a ton of crossover between those. How much duplication are you getting in your portfolio? How much of that duplication do you want, right? Because you might be maximizing your gains, but you could also be, you know, really increasing your losses on that side as well. So we think that it's really beneficial to have both sides. Ultimately, you have the mega funds, and you can really tap into, you know, some of their networks in terms of being able to dig deep, get access at some later rounds if we want to, you know, try to play the growth and the momentum side of things. But then to the point about having the sub $400 million funds, I mean, that's where you're getting like true intimate access to founders that are, you know, maybe just not even on the radar of anybody at this point. And so to get that kind of intimate access, I think plays really well, especially for, you know, our co-investment side of things as well, where we can continue to build relationships at a very early stage with founders as well as, you know, our early stage managers as well. So.
Great. And I'm going to have you guys answer the same question, but add on to it, like, have you taken it as far as putting them in separate buckets of pools of capital? So, like, you know,
yeah.
so
No,
Sequoia is coming back to market, so is Andreessen Horowitz. Like, are we competing with them for cash?
I think within the way we generally will think about it, and we haven't, to be clear, I haven't seen anyone delineate between like mega funds and not. What we have, the way we generally do think about the lineup within ventures in terms of relationships, not necessarily in terms of funds, right? Like, and we do have a target of, okay, how many relationships do we want to have here? And I think implicit in that is going to be how many of these are new versus old. I will say, I think overall Cambridge does tend to have more of a bias based off of just looking at those quilts of where are the returns coming from, right? Like, and it is these newer funds. And so clearly we are in some of those larger mega funds, but I think, but generally in terms of the new work that we want to do, you will in your lineup have an allocation for how many re-ups you're doing versus new names. And some of those, I think for those new names, we're generally going to be biased to, newer managers in general.
Yeah, I mean, the way that we've broken it up for a long time is, emerging manager, program and practice, and tenured managers. And it's not exactly based on fund size, but also there's a strong correlation. Like the larger funds tend to be the more tenured managers, not always. But it's because the funds have different return profiles. And I think that has been much more accentuated in the more recent years, as you identified, right? And with the big funds, you have a higher floor, but a lower ceiling. With the emerging, smaller funds, you have a much higher ceiling, but also, probably a lower floor. And so it's just a different style of investing. It's like, as you're building portfolios, you're thinking a little bit more about like portfolio construction, risk mitigation, et cetera. And again, as we talked about, there's going to be more dispersion of returns. It's going to be even higher in the smaller funds. So you have to be mindful of that. But we like that profile because that's where you're going to have the outlier returns really drive multiples on, we invest in funds, not individual companies. And we do co-investment, but like we're investing in funds. So if you want to drive multiples on funds, you need, outsized returns in modestly sized funds to really have deals in funds that drive portfolio returns. But that's not to say there's not a place for the mega funds as well. For us, we've kind of walked away from a lot of brand name firms because our LPs can access those directly. So there's also been a shift in tenured relationship set. And I know we're not the only ones, and I've seen that from endowments, foundations as well, that have kind of realized that there's a cap to what these funds can return. And so how do you think about venture? I mean, if you feel like you can get a similar return from a buyout fund with less risk and earlier liquidity, like why are you doing these funds? I think that's part of the dialogue sometimes. But yeah, there's definitely been a pretty significant bifurcation.
I'm going to ask the one selfish question for MaC, right? So you've all backed MaC across multiple funds. A couple of you, 3 funds. One of you across 2 funds. What was the conversation internally before you made the decision to re-up? Like what? And yeah, this is specific to MaC, but generally, how do you make these calls?
Yeah, I mean, it's obviously a very multifaceted approach. I think that it's a combination of many different things, and really what it comes down to for us is that we put a huge value on what the relationship actually looks like and what the communication level looks like. How often are we checking in, and ultimately, really just having a proper, transparent back and forth. Having that as kind of a core-rooted portion of the relationship for us is very important, and that obviously we can get into performance and things of that nature. But I think as far as the MaC relationship goes specifically for us, I think it's been you guys have always been very good to us in terms of being very responsive and being willing to talk and have hard decisions if that's what needs to happen. And I think for us, that's something that we place a lot of value on. Yeah,
I think all of our clients have different goals, right? Like, and they'll make different individual decisions, but generally, I think it will boil down to is what is this team going to be excellent at, and why does that deserve a spot in this portfolio? Even if we're thinking about 2021, 2022, when people were making tons of commitments. At most, you're within your venture lineup, right? Like maybe you're going to add 4 new names, right? Like to that portfolio, and our team obviously focuses on specifically women and people of color, but that's not who the competition is. It is if we are making 4 names in this commitments, then in this portfolio total, why is this one of the 4? And I think that has to boil down to not only what are you doing, but why have you earned the right to be excellent at that, right? And so specifically for MaC, I think it came down to focusing on this specific company and having a thesis, but being the right people to execute on that thesis, liking how the team came together, right? Understanding the value that you can bring to founders. So a lot of that will play into it. And then there's all the other, right, like complicating factors of pacing and sizing and things like that. But really, I think you just have to prove why you're the ones, right, like for people to take a shot on.
Yeah, I agree with all that. I think there's so many factors. I would maybe hone in on two things. One, I mean, we knew you before you started MaC, and for us, it was really important at the time. Like you guys, it was two firms coming together: M Ventures, Cross Culture, like new firm. Was this team going to gel? Right? Like that was really important for us. Like team cohesion, based on our experience, is a really important driver of successful, enduring platforms, and we just want to be really sure of that. And so that's why we observed you very closely over Fund 1, and then ultimately committed to Fund 2. Usually when we do a Fund 1 or Fund 2, we're like almost underwriting the next fund as well. And so that was like, so when it came time for Fund 3, it was like a pretty easy decision because we saw you guys were cohering really well. The portfolio was looking really interesting. And then the other thing I think that really stands out is just you guys are not afraid to do things differently, right? I mean, that was the original thesis of like the firm, and you're pursuing deals that maybe are not so obvious or overlooked by other VC firms. And you guys have stayed true to that, right? I mean, like it's the areas that you pursue now are very different than when you started the firm, right? And so you're not afraid to move with the market, pursue different things.
All right. Well, with that, I'm going to wrap us up here. Thank you guys for doing this. Really appreciate it.